Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending December 16th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme continues with the Grinch, and we all want to know if he's going to steal Christmas and the holiday spirit in the last couple of weeks of December, or will Santa come in for a rally? Well, let's just kind of take a look at where we were this past week, and let's see if we can't put some sense to the market price action right now. If we take a look at this past week, you can see everybody was in the red 2 weeks in a row. The worst performer, NASDAQ, obviously 2.72% down. Year to date, 31.57%. The S&P is almost back into their bear market territory, just a little bit lower, and we're going to be back into the bear market as we go through the end of the year here. Russell in the bear market, Dow almost in correction territory. So we're seeing intensified fears of rising rates, which is kind of what's pushing the markets lower for the past couple of weeks. We had two really highly anticipated announcements this past week. One of them seemed to move sentiment in one direction and the other moved it in the other direction. We had kind of the first number, which the markets like, was CPI. And then the second number, or the event, I guess you could say, was the Fed December policy meeting, which pretty much rolled the markets over for the remainder of the week. So what happened? Well, the CPI, it came in at about 10 basis point rise in November, bringing the year-over-year gain to 7.1%. But the markets were expecting it to come in hotter than that. So that was a good thing. And core inflation rose 20 basis points, but still much better than what the markets were expecting. So the markets moved up big time on the CPI data. But then the Grinch came in via Federal Chair Jerome Power Ranger Boom Boom Powell. He lowered the boom on the markets. And as widely expected, they raised the rates 50 basis points. It's 0.5%. And the prior four meetings, they raised them 75. So we did slow down a little bit. But markets tumbled a good deal within seconds of the release because basically he came in a lot hotter than people thought by saying that they need to continue to raise rates and they're going to fight inflation no matter what the CPI said just the day before. It was viewed a little bit more hawkish, that those comments that he basically said. So the median projection for the Fed funds rate in 23 rose from 5% to 5.1%, right? And keep in mind, the Fed officials, as of just September of this year, had anticipated the terminal rate next year at 4.6. So they've gone from 4.6 to 5.1. Markets didn't like that. I don't think the markets really believe them that much. And that's going to set up a conundrum for 2023. Is the bond market going to be right? Meaning they're not going to have to hike that high because inflation is going to come down faster than people think, or the Feds think anyway, and it's going to force them to put a pause on the rate hike action, or are they going to continue to just keep their head down and keep raising rates, putting the economy in either a soft or a hard recessionary spiral? Only time will tell, but that's kind of what I'm seeing here. And the other big issue coming up right now is going to be earnings kicking off in Q1 mid-January, and we're going to get the forward guidance on earnings per share. Members for our Sunday night session, we'll go a lot more detail on that and just kind of look at which sectors look better than others for 2023. We'll take a look at just kind of positioning, and based on our option masters session this past Thursday evening, you guys should be better prepared either for a bullish or a bearish market, especially with volatility. Okay. So right now, the current main policy rate sits on the upward bound of 4.5%. So if the terminal rate next year is 5.1, that's another 60 basis point rate hike. Now, the next Fed meeting is in February. I think the market's anticipating a 25 basis point in Feb and then another 25 basis point in March, or the probability of something 50 or lower, or 25. So that's what's got the markets in a conundrum, all right? You can see on here the PE ratio, the trailing is 18.91, the forward is 17.83. So they're getting closer and closer together. Earlier this year, the trailing was a lot higher than the forward. And we could see the forward earnings guidance go actually lower than the trailing, showing earnings are definitely coming down. The dividend yield 1.72, 10-year Treasury finished the week at 3.48. Still favoring the longer term Treasury, and I think we're going to see this 2023 money going into further out on the yield curve. All right, earnings yield 5.57% on the S&P. The real yield is still negative, right? A little over 2% to the downside. So that tells me more rate hikes are coming. Current VIX up for the week, 2 weeks in a row. It finished the week at 22.62. It was a lot higher than that on Thursday, but it kind of came in just a little bit on Friday. You can see the best performing sector, energy, which is also the best performer for the year. The worst sector is discretionary for the week, and for the year, communication services, all not very good. And of course, if we go over the pond, take a look at our brethren over there in Europe, you can see everybody was in the red from the Euro stocks, FTSE, CAC 40, DAX. Following the Feds this week, we also had the ECB. They raised their key interest rate by 50 basis points, so that took their rates up to 2%. And their last increase was 75 basis points, so which they did 2 weeks or two previous meetings back to back. The ECB President Christine Queenby Lagarde, who used to be the president of IMF but now running the European Central Bank, she basically said rates are going to have to rise significantly at a steady pace to reach levels in her mind and the ECB's collective mind that are sufficiently restrictive to bring inflation back down to the central bank's 2% target. And inflation over there is very high. The ECB also plans to shrink their balance sheet that they accumulated over the past several years with COVID by an average of about 15 billion euros per month. And they're going to kick that off starting next month, which also has the result of raising rates as well, right? So they're going to do that starting next March. The downturn also in the Eurozone business activity continued for 6 months in a row. A lot of people believe the Eurozone is already in a recession. So in December, we got the PMI. It ticked up a little bit, but it was at 48.8, which is still below 50, which shows that they're in a contraction type of environment. And not to be outdone, the Bank of England over in the UK hiked its key interest rate by 50 bips as well, another 0.5% raise. That's their 9th consecutive increase. They're at a 14-year high of 3.5%. Okay. Meanwhile, UK inflation fell from a 41-year high. It's still very high at 10.7%. And we are seeing the UK economy shrinking so far, 3 months through October, of 30 basis points. So I think they're probably already in a recession. In the euro, if they're not, they're going to fall into one early next year. All right, so just not very good. Everybody is in the red, and the only one that was in the green year to date as of last week was the FTSE, but obviously with the 1.93% move lower this week, they've moved back into the red, just 71 bips, 71 basis points, but they're still in the red. And then, of course, we'll go over and take a look at the Asian markets. Let's just get it back here. We'll go take a look at the Asian markets. You can see here both Nikkei, China, and the Hang Seng were in the red. They're in the red year to date. China moved back into, or they're in a correction territory. Hang Seng is down as well. We see in Japan, their PMI data show Japan's services sector expanding while their manufacturing sector contracted. Their exports are contracting, all right? And remember, who buys Japanese exports? The U.S. markets and the European markets. So everybody is slowing down. And then, of course, if we look at China, we had a trio of key economic indicators coming out for November showing weaker than expected economic data coming out of China. Remember, they're trying to end their zero COVID policy, but as you guys remember, here in the U.S. and Europe, when they ended, a lot of people still are afraid of going out. They're more sheeple. They believe in what they read on TV or see in the government news, everything. So they've kind of scared the population. It's going to take them 6 months or so to really come out of that funk that China is in. We did see their industrial production rise 2.2% in November, but it's still the softest growth for quite some time. And Chinese retail sales declined by almost 6%. But like Japan, the PBOC, that's the People's Bank of China. Why they put people in front of the Bank of China? The people of China have nothing to do with the People's Bank of China. Guess it makes the people feel like they're part of the process, but they're really not. But anyway, the PBOC injected almost 100 billion U.S. Liquidity back into their banking system. So they're still putting money into the economy, just like Japan is. Okay. So that's a little bit of a quick and dirty on the markets this past week as we go into the last 2 weeks of the year. Let's go take a look at the charts. Let me just flip the screen a little bit. And we'll start off with the S&P 500 E-mini futures, which is what we always look at as kind of a benchmark for the markets. I don't like the Dow that much just because there's only about 30 companies out there, and it's a little bit of a false read. The S&P 500 is a little bit better. The Wilshire 5000 is even better because you got all 5,000 stocks, but we're just using the E-mini S&P 500 futures for now. You can see we broke through these two moving averages or exponential moving averages. There's the 200 and there's the 50. And if I were to just kind of blow it up just a little bit on my chart, you can see here how we could not hold the 200. We came back up again, could not hold it. And now this past week on Friday, Thursday we closed below the 50, and Friday we just gave it an exclamation point. We could not climb back up over the 50. The 200 EMA vector is flat. The 50 EMA vector is pointing down. So that is not a good sign as we go into the last few weeks of the trading year of 2022. But I guess if you want to end 2022 kind of like it started, then let's just end it on a down note, right? I mean, now I'm going to show you something. If I were to move the EMA into a simple moving average, let me just change it to simple, right? And I'm going to show you the difference. If we move it to a simple moving average, notice it puts us right on the simple moving average, this red line. And I know a lot of algos are tied to both exponential moving average and simple moving average. When you hear a lot of the big money on TV talking about the 50 moving average or the 200, they're generally referring to the simple, right? The exponential, as you can see, moves the moving average a pretty good little bit. So we're sitting, just a few points below the 50 simple moving average. I like to use the exponential, but you got to understand that both the exponential and the simple are used by big money algos to trigger more buying or more selling, right? So that's what we're looking at right now on the markets, and it's a little bit of an interesting dichotomy here. You can see we moved up over. We could not take out the prior pivot high over the 200 EMA, so now we're coming back down again. All right. Now, if we look at this on let's look at it. I'm going to shift the screen just a little bit here, and I'm going to look at it on a weekly chart. If we look at this weekly chart of the SPX, right? Again, this is a weekly chart, and you can see on this weekly chart here, and let me just blow it up just to kind of give you a little bit of a better idea. So each bar represents 1 week in a time frame. So the red line is a 50-week moving average, which is similar to a 200, not quite, but close, okay? And if you look at it, you can see the high for the week kind of kissed that level. The low for the week was down here. All right, so if we look at these two lines here, notice the prior line or the prior week here. So this is a bearish engulfing pattern. Basically, we made a higher high and a lower low from the prior week, okay? So that would suggest in a bearish engulfing pattern, the price action and the momentum wants to go lower. That would be the suggestion of what the charts are saying. If we do go lower, I think we're not going to get much lower than this yellow line, okay? This yellow line is the equivalent of a 1,000-day moving average, and it really kind of divides the line between a serious bear market and then just, a very weak, soft, recessionary type market. So, and you can see this downsloping trend line, we cannot get up above it, right? We cannot move above it. And that a lot of algos are also primed into, okay? So I would suspect before the end of the year, the momentum is down. And volume and liquidity are going to go down as we go through the next 2 weeks of the year. And that tends to make the market more choppy. We're also, this past Friday, it was triple witching, where we had monthlies and quarterlies and indexes all expiring, and there was like trillions of dollars worth of nominal value in these options that all expired. So that has a tendency to make the markets very choppy, which is what it was exactly. So momentum is pushing us to the downside. So I'd give us a more than a 50% chance that the momentum will carry us from Friday into Monday and Tuesday. And then we may get the counter rally, which we always get. You just don't go straight down, right? You get the counter rally. The other thing I wanted to show you on this chart is just keep in mind that we had a rally here back in February, March. That was about 516 points to the upside. And then we roll back over. Here we had a rally that was about 690 points, and then we roll back over. Here the rally was about 592 points, and then we roll back over. So folks, these are big rallies. These are what you call bull traps, where you have a good counter-cyclical move in an overall bearish market. Okay, the only way this is going to end from a technical pattern standpoint is to climb above that downsloping trend line and then hold it. We may do a retest of the trend line, but you got to hold it and you got to move higher. You're going to see, excuse me, the Elliott wave count on my system is showing this is a 3 wave and showing we got a possible 3-5 wave here around the 4,400. Now that could go out to the end of next year, all right? I am telling our members to prepare for more of a downside move in Q1 into early Q2. At which point we'll probably bottom and finish the year strong, but we're not going to see the highs we made early in 2022, not for 23. I think we're not going to take them out until 2024. The big caveat in all of this is what the Feds are going to do with interest rates. Because remember, the higher the rates go, excuse me, the higher the interest rates go, the more it's going to damage the markets, because you got to revalue all the stocks, PE ratios come down, and that's going to drive the markets down. And consumers are going to slow their spending habits. Companies are going to have to reduce the price of their goods to move them off the inventory shelves, clean out the shelves inventory. That's going to cut profit margins, and then you're going to see that reflected in the share price, okay? So keep in mind, the run up in stocks next year, or bond prices and credit, basically rests on a triple assumption that A, inflation's going to recede, which I think the market's pretty much betting on that because we've already had peak inflation. That the Feds are going to be wrong about needing to keep rates high to control inflation. I think the markets are making the bet that inflation's going to come down a lot lower than the Feds are forecasting, and that's going to allow the Feds to pause the markets or even come down just a little bit interest rate hike towards the end of next year. And that's going to also cause the markets or the Feds to realize that they don't need to force a recession to get inflation down. So those are the three things. And if the market is mistaken on any of these three, then the rally is going to reverse and we're going to go lower. So those are kind of at a very macro level what we're looking at going into 2023. Right now, the odds still favor the markets to move lower in the first half of 2023. All right. And I think you're going to see a lot of people lining up to buy stocks, waiting for that pullback in February, March, April timeframe. And then once we get down there, you're going to see a lot of buying come in. The other chart I wanted to show you, I use an indicator the few don't use, but I like it. And let's go take a look at it. We're going to look again at the SPX, and we're going to do the same thing on a weekly chart. And you can see here these lines going up. That's an Andrews pitchfork. I used the prior pivot low back in 2018. And then I used the COVID low to define the Andrews pitchfork. And then I used the previous high right before COVID. So these are very good solid points. And then you can see the channel it creates with the blue line. That is the midpoint of the bull bullish move that we've had since 2008, 2009. And you can see how we're testing it. Now you can see I got a bunch of lines in there. One are Fibonacci extensions and the other are Fibonacci retracements. Okay. The extensions or the dark lines, the bigger, bolder lines. The retracements are the thinner lines. And we tend to find support and our resistance where you have areas of congruency, which means you got these lines coming close and overlapping. So you can see right here, we got that blue line, the center line of the Andrews pitchfork, along with these two lines here, we got the extension and we got the retracement. And they're fairly closely lined up with each other, okay? And I don't see us really near term taking out the 0.236 retracement, which is around 4,200 through the first half of next year. I think we're going to stay below that. I believe the first half of the year, you're going to see us come down here and take out that 50% level, which is a retracement of the lows to the highs, right, since the great financial reset. We're going to take that out. And my new range for the first half of the year on the downside is 32 to 3,300 because I think the PE ratios are a little bit too high. They're going to come down at the end of February when we get through earnings. You're going to see them recalibrated lower, which is going to recalibrate valuations in the markets. And then we move lower. And then we're going to start the big buying spree that a lot of big institutional traders and mutual funds are looking for, and then that's going to carry us up through the end of 2023. Okay, so that's a little bit about what I'm seeing right now in these markets. Now it can all change with just a couple of words or press conferences by Boom Powell or any other key voting member of the Fed, but that's what I'm seeing right now. Okay. Now I'm going to switch this over and let's go take a look at the volatility. Okay, so if I just switch this and move over here, you're going to see the VIX. We're back into the red zone again. I know it takes about 10 seconds for you guys to see it on your screens, but you can see we're back into the light red zone, and I divide it between 20 and 30. And the midpoint of the red zone, once you get over 25, then the markets statistically, statistically, I couldn't say the word. The odds favor the markets to be lower. If you look at the history, every time the VIX has been over 25 and hung out there at that level for a while, 6 months later the markets are lower than that price. 6 months. When it's lower than 25 down to 20, then what happens is volatility statistically is volatility's a lot higher, but it's very choppy. And then below 20, the markets tend to move up higher over the next 6 months in time. So we're right at that level where we're at the chop level. I mean, you can feel it, right? You can see the 50 EMA has moved below the 200. So that's a good thing. I don't see us really having vol, even though we may move lower through the end of the year. The market forecast and momentum seems to suggest that we're not going to have, I don't think, any scare the children moments. Okay. But it's going to just kind of grind here. And we'll see how this thing goes, unless there's an unexpected news event or some words from the Fed. I just think it's going to be a little bit choppy through the end of the year with the odds favor neutral to slightly bearish. Okay. If we come down here and look at treasuries, if we look at the 30-year bond, well, that's way out on the yield curve. And you can see it was down pretty hard on Friday, but it's up. And I suspect it's going to continue to move up, which interest rates are going to move lower. Why is that the case? Because everybody now likes the idea of drawing in over 3.5% in interest and a very safe way to go. Not everybody, but a lot of people do. And that also is not a good vote of the economy, right? When you see a lot of people buying 10 years and later out on the yield curve, that typically means that people do not have a vote of confidence for the economy going out in time, because those rates are actually coming down as they buy them, okay? Which is against what the Feds want to see. The Feds want to see these rates going up. Clearly the 2-year is going up, and the 5-year and the 90-day T-bill. They're all going higher because they track what the Feds are doing. But once you get beyond the 10-year, they're coming down a little bit. In fact, speaking of the 10-year, if we look at the 10-year interest rate, you can see it hit my target and kind of chopped around there. It moved below the 50 EMA, and we're sitting right here now. I do believe the Elliott wave pattern suggests the 10-year rate is going to move up as we go through the end of Q1 of next year. Let's see how this thing pans itself out. I don't think we're out of the woods just yet on the Treasury market. We got to watch it very closely. Okay. And of course, if we look at currencies, the dollar's another one we want to follow very closely. It's moved up a little bit over the past few days, but it has come unglued. Right over in this area over here, when we broke the 50 EMA for the second time, I got our members in the euro. All right. And whether you want to go long euro dollar in the currency market or just go long the euro, that was the trade to make. All right. And we got our folks in. A number of members are doing very well in that trade. And if we come over here, we saw the final break of the 50 EMA in the dollar back in early October. And if we look at the euro, you can see here with the euro, we finally broke to the upside and took out the prior pivot high over the 50 EMA. And you can see that yellow dashed line there was my signal to send our members long. Right. And you could go long the euro futures. You could go long FXE, Foxtrot, X-ray, Echo. And in fact, if we look at it, this is the ETF that tracks the euro. You can see the exact same movement right here. Okay. And that was the area when it gapped up the next day. Just go long and you could do very well. Right. And currencies we like to trade because the trend lasts for quite some time, typically over a year. Now you get chopped within the trend and you just got to learn how to buy at the bottom of the channel and sell at the top, or just take profits at the top, but stay within that channel. And I see this continuing through next year, even though you hear about Europe, and the energy crisis and high inflation and being in a recession and on and on and on. Logic would say stay away from the euro. But the dollar is not where you want to be. I think over the long term, the dollar is going to come down even another 20%, and you'll see the euro much higher. So you just have to follow the price action on the charts to really understand it. And then, of course, if we come down here and look at gold, I think longer term is going to be onto the upside, right? You can see the break in the 50, the test of the 200, the retest and the break. We may come down and retest the 200, but long term, I think gold is going to come back up. Now, notice gold is still in the red for the year because the closing price of 2021 was 1830.50. These are gold futures, right? So I do believe that's going to break, and it should have a better year next year with gold. Okay. And same thing with silver. And of course, if we look at copper initially got these thrust higher because China's getting rid of their zero COVID and they're moving up. But if we do have that global recession, China's going to get hurt a lot. And I think you're going to see copper come back down. My target for copper, which I'm sharing with you guys here, has always been, and I've had it for quite some time, I've had it all the way back to late summer, was down here around 2.71. And you can see how we just kind of had that extended Elliott wave 4 with a lot of chop in the middle of it. Elliott wave 4s tend to be very tricky to trade anyway. But this would happen if we get a more than a soft recession globally. If Europe gets hit hard, China gets hit hard, then it's going to wash to the U.S. shores. And then if everybody's in a recession, you're going to see copper come down. Copper is a good placeholder for where the global economy is going, right? And then the second half of the year, it's going to move up, just like the rest of the markets. And then, of course, if we look at energy, there's a lot going underneath the covers of energy. You can see energy's below the 2021 close of 75.45, right? It's in the red for the year, not at the low price for the year, but pretty darn close. We've been moving down. Really the peak in energy was right around the summer months, and then we've been moving down since. So energy is always, and these are, when I say energy, I'm talking about oil futures. Notice the energy sector is the leading sector for the year. XLE is no other sector. I think it's the only sector in the green this year, and it's in the green by 54, 55%, right? Well, to be exact, 58.87, almost 59%. XLE. Yet futures in oil are in the red for the year. So there is a dichotomy between the two, right? And I do believe they're going to close that gap, which means XLE is, and I know a lot of gurus are saying be in energy next year, but it's had such a great year. Be careful of a setback in energy, XLE, and a move higher in oil futures for 2023, right? Just to close that pair trade gap. I can see that happening. Nat gas, even though it was like one of the best performing commodity sectors for the year, we made our money selling it. We sold it over here and we sold it up in this area here, in this blue zone. Anytime nat gas got in this blue zone, my trade for the members was to short nat gas. And the best way to do that is just buy a put in natural gas futures and hold on, or just short UNG by buying puts or buying bear put spreads, or just long puts. But I love mismatches in the commodity market when you get 5-year highs or 5-year lows. You just want to take advantage of supply and demand and go in the other direction. Hence our logo, the red striped zebra. You got to be different in the commodity market. Now we're kind of in this middle area. It's a no man's land. You can see here if I blow it up, I mean, it's going from green bar, red bar, green bar, red bar, green bar, red bar. That is what you see when you get to these lows or to the highs, right? So to me, there's no trade in that gas at this point in time. All right, everybody, that's kind of where we're sitting. I wanted to kind of just give you guys a glimpse as what I think going in the last 2 weeks of the year. Keep in mind, with lower liquidity, lower volume, any kind of press announcement by the Feds or any news event that's kind of unexpected can move the price action up or down by 50 to 100 points very easily. Momentum typically on Friday tends to continue into Monday, and since momentum on Friday was going down, the markets will tend to kind of move down on Monday and Tuesday. We'll see if that translates into price action that way on this coming Monday. Have a great weekend, everybody. Members, I'll see you Sunday night for our weekly market watch. Take care, everybody. Ciao now.